America's top banker has talked about green shoots appearing in the US, but the only thing growing in the Eurozone is debt, according to this week's grim OECD report. The European Union is under pressure to boost its debt firewall amid mounting worries over Spain's woes. In the centre of the financial hub, I'm joined now from London by David Buik at BGC Partners. David, good morning to you.
Hello to you, Tiki. Greetings.
Now, the latest news seems to be that the European Central Bank is good for yet another round of bailout through the LTRO.
Well, it seems to be the only game in town here. You know, they seem to have shot most of their bullets, and I suppose there's one left in the chamber. And they might as well keep firing because they've got nothing else. The fact remains is that they've all done all they can. This firewall's now been built up to 940 billion euros. It's a catastrophic amount of money. All the goodwill by the central banks has been shown. Or the rhetoric, I mean, William Shakespeare would have been absolutely thrilled with it, the way that, you know, we're going to go around the maypole and we love each other. But the implementation looks dire to me, particularly in the case of Spain. For your own eyes, you've seen what's happened on the streets of Madrid, follows in the wake of what's happened in Athens. And I'm sure it's going to happen in other parts of Spain, Greece and Italy before too long. Italy, I think, is a different ballgame. It's a rich country. But Spain has a real problem with over 40% unemployment between 16 and 24 years of age and over 20% overall, with just the sunshine, the eastern belt of property, and the odd glass of wine, which is very grateful. We're all very grateful for, and a glass of sherry. But what else is there that can turn round to give us growth? Very, very little.
And I see that despite all this, we've just had on the wires that the new OECD numbers about growth, that rich nations will outstrip the growth forecast for the first half of 2012, but the European economies will lag behind the US.
Very much so. I think, you know, if we get 2.1%, according to the OECD, in the United States of America, we'll be happy. We have seen sufficient evidence, Tiki, in the last couple of days that suggests that if we don't go back into recession by the second quarter in Europe and the United Kingdom, we might well have done well. I think we won't, but we'll be bouncing along at the bottom, and we really need to see the level of growth stimulated by lots of activity that can reciprocate trade operations that are so necessary with your part of the world, also with Asia and India and the United States.
Well, there we have the ECB looking at a further bailout, but they've also said that loans to the real economy fell in February. So how much good is all this bailout actually doing?
Well, this is what we don't know, you see, whether it's whatever quantitative easing it is or it's the LRTC or whatever, is that all you know is that it goes into the banks because of their liquidity problems and their inability to raise money through wholesale money markets. But what we don't know, whether it's earmarked for certain areas, such as small and medium-term enterprises who desperately need this money. The problem is with the banks in Europe, they are so short in places of capital that what they're doing is trying to shore up their balance sheets, and they are not prepared to make any risky loans at all.
Well, I see in the UK, if I could interrupt, I see in the UK today the New Buy flagship scheme, which was designed to revitalise the housing market and kickstart the economy. That's a classic example of what you're talking about, isn't it? Because the banks are just not lending.
Yes, but we've been there, Tiki. We've seen the film, we've got the T-shirt, 95% mortgages, even if it's for new houses, is dangerous. When you see £26,000 as the average salary in the United Kingdom and houses of around £120,000 to £200,000, you don't need the brains of a rocket scientist to work out that those loans cannot, in the long term, be sustained. When interest rates are down at these levels, they can. But they're not like door numbers, they move. We've been there, we've done that. It is dangerous. And banks are looking at it and saying, we hear the government, we understand that they're prepared to underwrite some of this stuff and endorse it. But the fact remains, as far as we're concerned, when we're trying to get our balance sheets back into shape, this is dangerous business and we don't want it.
David Buik, I think the watching brief is now on Spain, but we'll talk to you again next week, I hope. Thank you so much for joining us. Thank you.
Bless you.